Hello and welcome back to the ROI channel, the channel that's obsessed with the scientific art of return on investment. Today we're talking about another position in our eToro portfolio, Scorpio tankers, listed on New York Stock Exchange, ticker STNG. Very, very exciting opportunity, and it's a little bit different in terms of the valuation. So we're going to be looking at an asset valuation today for Scorpio. Thank you to those who have subscribed to the YouTube channel. If you haven't done that already, I would greatly appreciate you doing so. Give it a like and a subscribe if you've been getting value out of these videos. Today, we're using our a speculation formula, technically, our Crassus speculation formula, and that forms a part of our tail end of our portfolio. So there's smaller positions with a little bit higher risk, but with potentially outsized returns. So what differentiates speculation from gambling? Well, we've got a method to our madness when it comes to speculating. So this is the formula that we're looking for. We still need a margin of safety, and that's a concept that never changes, whether we're looking at cash flow investments or we're looking at, in this case, asset plays, or even speculations in terms of perhaps a commodities producer that might be exploring new ground and is about to, we think, strike it big in terms of drill holes for oil or for precious metals or uranium, whatever the case might be. We want a contrarian thesis, and the reason we want that is where we've got our opportunities often lie between the delta between narrative and reality. Okay, and at the moment, people seem to think that we've hit peak oil demand, and that is just a joke. We have not hit peak oil demand, in my opinion, and won't for several years. If you think about the population of the world, you've got, let's call it 1.3 to 1.6 billion in the the so-called affluent Western worlds. That leaves a hell of a lot of people, okay? The majority of the people still in the developing world who will need and want to use more electricity to increase their quality of life. And over the next at least 10 years, if not 20, they are not going to, and nor should they, refuse the ability to use power and electricity. And given the fact that that oil is a key ingredient still and will be for many decades, the demand for oil has not peaked yet. Okay, so we've got a contrarian thesis, convexity bias. What does that mean? It means we have a limited downside and exponential upside. Okay, so high reward, limited and defined risk. Not no risk, but risk that is limited and defined. And obviously we use an appropriate allocation. We don't bet the farm on risky speculations, but they can provide, as part of a well-constructed portfolio, an intelligent amount of speculation can provide outsized returns over time. And we want our exit strategy. Okay, so this is not necessarily a sector, it's a cyclical sector, so it's not something we're going to put away and hold until we die necessarily. We're going to be looking at the macro forecasts and looking at the current situation and having an idea as to when we want to pull the exit button and roll that capital into another opportunity. Some quick facts on the company. So revenue is expected to come in just shy of 600 million, and that's given the atrocious year that was COVID last year, don't forget, where oil futures went negative. Okay, and that was disastrous for basically anyone in the oil business, including the tankers. They've been able to grow their top line at 22% compounded annual growth per year over the last decade. Now that's fantastic for such a capital intensive business. You think about the repairs and maintenance on a tanker and the capex, it's a really good effort to be able to grow top line at 22% every year. EBITDA 466.1 million, compounded annually over the last 10 years at 44%. So massive growth in the EBITDA and good strong profit margin growth. Market cap 987.59 million, enterprise value 3.86 billion with a B. So they are carrying quite a bit of debt, and that is what we need to keep in mind with this type of asset play. The share price as of recording, $18.10. I began looking at the company when it was around about $15. So I was a little bit, may have missed a trick, but we've still got plenty of upside, as you'll see later on in the presentation. 54.5 million shares on issue, and they were able to reduce that actually last year, 1.5% reduction over the last 12 months. Given COVID, that's an excellent result. Dividend yield as well, 2.2%. They do use a bit of finance to pay out the dividend. I don't like that practice generally, but I do understand, I suppose, from the board's perspective, by paying a dividend, they make their stock more attractive to a certain group of investors. So it increases the potential buyer pool for their shares. But generally speaking, I don't like to see unsustainable dividend yields. I'd rather the company just keep the yield, or keep the dividends and pay down debt or increase developments towards free cash flows. Return on capital, about 5%. That's as of a normal year. So take last year out, they were negative over the last 12 months if you're looking at 12-month year to date. Net debt to EBITDA, 5.8 times, okay? And normally, you'll know, if we're looking at a long-term business where we're analyzing the free cash flow as our main point of interest in the investment thesis, that would be way too high. Okay, we'd be looking at no more than 3. However, this is an asset play, so we're looking at the raw assets of the company. If they go bankrupt, what is the liquidation value of their assets? And if we can buy it for less than that, we're interested, because any good performance in terms of cash flows is a nice little upside. So here's the performance over the year. These companies are in the shipping tanker space. So you've got Sting at the top, which is Scorpio tankers. We've got Frontline and Euronav. Okay, so they're I would say they're the big 3. Scorpio has outperformed, as you can see, compared to the other 2 players in the industry. And interestingly enough, Scorpio is trading at a much lower ratio of its book value. Okay, so its price to book is a lot lower than the other 2. So that's of note. They've outperformed in terms of price action, and they're actually cheaper if you look at it on a relative basis, valuing the assets. This is a great little diagram. So I've taken some images and some charts from the company presentation, okay, so the quarterly review, quarterly report, and also from a great article that was put that gives a market overview of the tankers. So I'll leave that link in the description, and also a Reddit article. Okay, good old Reddit. But this is a great way to show what the business is. So here we've got either our, in this case, they're talking about offshore rigs. So you've got a platform here that might be Transocean, for example, another company that we own, leasing it out to Chevron or ExxonMobil, whoever the case may be. They're drilling into the sea because many reasons, which I've covered in the Transocean video. One might be that you only have about a quarter of the emissions by using deep sea. So that's another reason. They will pull up the oil, put it onto the old tanker. That's a crude tanker, okay, and they'll travel to and from, okay, various destinations. So if you've got storage tanks over here, you can sit crude oil in there. Crude tanker takes it to the refinery, and then you get a refined product, so an enhanced crude oil or petroleum, any kind of refined hydrocarbons, which is what Scorpio carries. So the other tankers, Euronav, etc., they take crude oil, generally speaking, but Scorpio does not. They use enhanced petroleum products as part of what they carry. And they'll take it, as you can see here, from the refinery over to the end user. Okay, so that's a great little mental map for you to keep in mind to get your head around the business if it's foreign to you. Some key points on the business. So Scorpio is the youngest fleet, okay, youngest, best dressed fleet. What do I mean by that? Their assets, their vessels are in the best condition. They're on average age there, you can see 5.5 years, very, very young, okay, which I'll show you on a relative basis in a moment. They have the best assets and the best fleet, okay. They are, well, all the tankers are recovering from the market that was last year. It was a horrible market, and so we're coming off an all-time low, which means we should be catching a wave in a secular bull market, which is the oil market. Quick ratio is less than 1. What do I mean by that? So quick ratio takes liquid assets, so current liquid assets minus liabilities. If it's less than 1, they have less cash on hand to pay out their current liabilities, okay, and that's important. And so we would say, again, using an asset play, we want to be really sure that the assets are worth a hell of a lot, because this company could be going bankrupt and they would have to pay out their note holders and bond holders before we would have a chance at reclaiming any of our equity value. Okay, so that's just an important thing to keep in mind. Okay, refined product floating storage. What does that mean? So if you look over here, this would be typical. So before COVID really hit and we had all those lockdowns and demand ceased because everyone was worried, they didn't know what was going to happen. Up in the top corner here, you can see you've had over a fourfold increase in the storage requirements. So in other words, a fourfold decrease in demand. Instead of going from the refinery straight to the end user by the carrier ship, basically companies like Euronav and any old tanker, any old space was used as a floating storage. So they were just doing figure eights in the ocean, holding the oil and waiting for demand to come back online. Now, when you've got that, you don't need a specific vessel. You don't need the youngest and best dressed fleet that is owned by Scorpio, because you're not really concerned with the transportation as such. You just need a place to store it. So if you've got a rusty old bucket somewhere of a vessel or even land storage, you're going to keep it there. You're going to cut your costs. And so day rates for vessels came down because there was far less demand for their service. That's all about to change though. So let's go into our thesis in the tankers, and I'll do something a bit different. I'll start from the top down, do a little bit of a macro, and then we'll go relative, so intra sector or intra industry, and then we'll talk about the bottom up analysis for the specific company. So macro, we know there's an oil bull market. If you don't know, surprise, there's an oil bull market heading your way. Well, it's already here. You've seen energy crises all around the world, people going without power. And that's going to mean higher day rates for these carriers, okay? Scorpio is the best carrier, so they can command the best day rates. So their free cash flows, their EBITDA is going to start to really pick up over the rest of this year and into next. COVID led to tankers and carriers basically use the storage holes rather than transport vehicles in their true purpose, as we mentioned before. This is extremely important, so listen closely. 25% of the global fleet will be more than 25 years old by the middle of 2022. I'm going to say that again. 25% of the entire global fleet is going to be older than 25 years old by the middle of next year. Okay, so when you look at the number of vessels out there, most of them, a quarter of them will be more than 25 years old. They're ready for the scrap pile, okay? Very rare that if you're using enhanced crude oil or petroleum products, you don't want them stored in just any old fleet, okay? You want to use the best, most appropriate vessel for the job, and they are owned by Scorpio. 60% of the global fleet will be over 15 years old by the middle of 2024. Okay, so in 2.25 years, almost 2/3 of the entire fleet population in the world is going to be put out to pasture. Or if not put out to pasture, they're going to be really on the nose, because you can't just use any old fleet for these more refined hydrocarbons. And if you look at a presentation that was done by Euronav, they basically give a functional lifespan of 15 years. So if you've got a vessel that's older than 15 years, it's on limited legs. It's like an old racehorse that's run his races and it's time for him to go out into the paddock. Oil tanker owners made a lot of money during the boom periods of 2019 and 2020. That's early 2020. No one's short on cash and find themselves actively seeking asset liquidation, says Peter Sand of BIMCO's chief shipping analyst. And I'll leave a link in the description, because the market overview there is a really, really interesting read. And I didn't want to put more detail than I already have in here, because the video will go way too long. So this is our liquidity issue. We want to make sure that we can just get through the next quarter. Okay, so this has been shot in October 2021. We want to get through the end of the year and into 2022. Oil prices will start to re-rate, and the day rates for these carriers will start to really take off. More tankers scrapped in the first quarter of this year than in last year and the year before combined. Okay, that's huge, humongous. 2.1% reduction in the active fleet. What are the factors for that? So we've got low day rates, of course. So if you've got all these buckets of metal or steel sitting around in your dock, and they're costing you an arm and a leg for maintenance and you can't rent them out, you got to do something, or your cash is just going to be burned through. Okay, you got nothing on the balance sheet and you're going to have to file for Chapter 11. So what do? You look at the ships that you can get rid of and you say, okay, we'll sell as much of these as we can. And with record steel prices, it made sense. So the stars aligned there. You're getting record steel prices, you're getting nothing for your day rates for your ships, and you're a company typically that carries a lot of debt, and that's what these companies do. So you say, well, okay, I'll cash in my old 15-year-old vessel. I'll get $8 million for it. I've already depreciated it fully. I don't get any more depreciation. So if we can get $8 million back for it, that beats the hell out of paying $35 million to build a new one. And so you can wait for the demand for oil to re-rate, and your day rates, the amount for which you can lease out your vessels, will go up. And then you've got the ability to cash flow your operations from free cash flow rather than having to finance all the time. Okay, typical commodity services business. Okay, so relative valuation. We've looked at the top-down big picture of what's happening in the world and in this particular market. Now we're looking at inside this sector and inside this industry, who are the players? So we mentioned Euronav, Frontline, and Scorpio. Which one of them do we want to go with? That's the next question. So if we compare one to the other, what clues does that give us as a relative valuation? So Scorpio is the youngest fleet. We said that already. High demand at higher rates with decreasing competition due to those factors: age and the fuel type of the carriers. Okay, so most of the other companies that are competing in the sector, they've got the older fleet, so they're going to be offline soon. The fuel types. What do I mean by the fuel types? If you're an older fleet, okay, you must use very low sulfur fuel oil. Okay, that's this acronym here, VLSFO. Okay, a regulation came in 2019 that dictated or mandated that if you didn't have exhaust scrubbers fitted to your tanker, you needed to use this particular type of fuel that's low in sulfur. Now, that's all well and good, but the problem is it costs $100 per megaton more than the standard sort of higher percentage sulfur fuel oil. Okay, and that's very significant because Scorpio has the younger fleet. They're much more upgraded in their technologies and the type of vessel that they have, and they have exhaust scrubbers on almost all of their vessels. So that gives them a huge advantage. It translates, if you work it out, most people estimate to about a 17% fuel cost advantage. So think about this. If you're a carrier and you get to pay 17% less for the fuel to run your vessels, you automatically out of the gate have a huge advantage. That's before you factor in the fact that your fleet is younger and that they're more up to date, they've got better technologies, and you have more vessels. Okay, who are you going to go with? The guy that's got a couple of rusty tankers that have been hanging around for 20 or 30 years, that they've got to pay 17% more for their fuel cost. That cost's going to get passed on to the customer. So Scorpio can compete at a more competitive price and deliver a better service. Okay, so to me, that's a no-brainer. Okay, from the quarterly review, this is from the article from BIMCO, I believe. This is a great visual representation of where Scorpio sits versus some of the other players in the industry. So on this is the x-axis, okay, and then you've got the dependent variable f of x here, the y-axis, if you want to think of it that way. Up here, this is the number, okay, so total number of vessels in the fleet. So you can see Scorpio's way ahead, way ahead. The different colors are the different types of carriers. And if you look down here in this little orange circle, that's the average age. So look at the difference between Scorpio's average age of vessel versus its competitors. Okay, it's basically half. Okay, they got almost double the fleet size, that are half the age. They are in the best position to be able to take advantage of this bull market. Now, get my head out of the way. Exhaust scrubbers. This is just touching on what I mentioned earlier. So if you look at the rest of the global tanker fleet versus Scorpios, look at the percentages. Here we are as in May 2021. So almost all, 84% of their carriers have these scrubbers installed. Okay, so they're getting a huge advantage when it comes to the fuel type and a few huge discount really at the end of the day. So that's a great visual to give you an idea as to where they sit competitively relative to their competitors. Okay, so now we decided that we think the best horse in the race is Scorpio. Well, I think anyway. Bottom-up analysis. So remember, this is an asset play. We're not looking at the cash flows. We just want to know, we think they can survive through to the good times. Great. If worst comes to worst and they've got to sell off all their tankers and all their equipment and everything else, what are their assets worth? Worst case scenario. So book value, what is that? If you don't know much about accounting, don't stress, you've probably got more of an exciting life, so congratulations. Assets minus liabilities technically is your book value. However, you need to be careful using that. You need to go through and make sure that the book value is talking about real tangible assets, not just, accounts receivable and goodwill and all these sort of intangibles. Exclude that and look at the market value, okay, so the resaleable cost of their tanker assets and equipment. So that works out to be around $35, okay? So if we're paying $18 and we were to sell off all their tankers and all their assets and get $35 on a per share basis, obviously we're ahead. So that would give you a price to book, that's what that little PB stands for, of 0.5 as a ratio. So you're paying half the amount of the asset value of the company. Cash to cover operations for 2 to 3 years. So they should be able to get through into the next year quite easily and start to see the re-rating on their day rates, which means they'll start making some money and grow their free cash flows. EBIT to interest is just above 1, but just, okay? It's not good by any means. That is the amount of income that they earn before having to take into account interest and taxes, compared to them, usually it's monthly interest payments. Okay, so if you've got a mortgage, think about it this way. You get money coming in and then you've got your monthly servicing. Are you above that and are you positively geared or cash flow positive for our American brethren? Or are you in the red and your mortgage is costing more than the revenues from the house, let's say, if you're talking about real estate and mortgages. So the revenue the company earns minus its cost of goods sold more or less gives you the EBITDA without going into too much detail. And then you've got to pay monthly interest on the financing for the company. Okay, so they can meet it, but it's a very fine line. I would prefer to see that much higher. Last 10 years, price to book. So historically, if you look at the last 10 years, what's the price traded at versus the book value? The mean is 0.74, okay? And today, if you look at the competitors, they're trading at a mean of 1. So the fair value for the other competitors in the space is 1 times their book value versus Scorpio, which is trading at half the book value. So we've got a good indication there that we're looking at an undervalued company relatively, so relative to the competitors in the space, and also from an asset valuation, okay, from a tangible asset valuation. Historically, the high has been as high as 1.4, okay? So we're pretty happy that if we get a multiple reversion, we're going to make a lot of money on the upside purely from the asset play. So we take our book value, okay, and we use 3 cases. So the first would be if we simply revert back to mean over the next 2 to 3 years. If we go to the mean of the industry, meaning you've got the other guys trading at 1 times book, and instead of Scorpio being undervalued at half times the book, it comes up to match those. And if we go up to the historic high, what does that give us? So these are the implied prices. Add those together and get an average, and you've got $37.70. Okay, so you've got an equally weighted average, gives us an estimate that it should be trading around about $37.07. That's what we think a reasonable estimate for the assets are. Okay, if you look at it, that's huge. That's a double. Okay, 208% on the upside. That could happen quite quickly if we get this oil price reversion, our re-rating, and the oil services companies start to do very, very well. You'll see their multiples start to increase, and so I think that could happen maybe by the end of next year. Who knows? Certainly by the end of 2023, it's not a stretch of the imagination. What does that work out as an IRR? Okay, so if we were to hold this for 2 years and get our 208% upside, that's a 44% IRR. Okay, so humongous annualized rate of return. If it took an extra year, that would be 28%, which is still phenomenal, absolutely phenomenal as an annualized rate of return. So what's the verdict? We're going to buy the assets. I bought the assets. It has a place to play in the portfolio, and I'm very excited about this type of opportunity. But expect volatility and expect some uncertainty. Okay, it's not going to be an easy, straightforward ride. It may be a restructure, but I doubt it. I think this is a company that's seen the worst time you could ever get as an oil services company. I don't know if it can get much worse than negative future prices for the oil. They've survived that, and so I think they're here to take advantage of the good times. There's a margin of safety. There's a contrarian thesis. We have a convexity bias that's in our favor. We have outsized returns that are possible. 44% annualized return is definitely outsized. We have a limited and defined risk. We know what that is, and we think we can still profit if the worst were to occur. An appropriate allocation strategy, and we have an exit strategy. So as we start to re-rate, once we get to around about that 1x book, I'll trim a little bit of the profits and hold on so that we can hopefully get that overshoot. We currently got 1.2% of the assets under management, okay, which should, if we can get a double, that will really provide an outsized return for the overall portfolio. Thanks for watching. Bit of a longer one, put a lot of detail in this one, so I hope you enjoyed that. If you haven't checked out the eToro portfolio, click on the link in the description and you can either add us to a watch list, or if you're ready to rock and roll, you can hit the copy button and start sharing the gains. Thank you to those who have subscribed and liked to the YouTube channel. Greatly appreciate that. I really do. If you've got feedback or any questions or comments, feel free to hit me up in the comments section. Otherwise, always the disclaimer, make sure you take responsibility for your own investment decisions. Make sure you're sensible about who you listen to and who you don't listen to. And at the end of the day, you're responsible for your investment process and investment decisions. So make sure you take that responsibility seriously. Thanks for watching, guys. I'm going to leave it there. I wish you all the best, and we're going to come back for another video later in the week.